Welcome back to another episode of the B2B Founder Podcast. I'm your host, Brett Trainer. Today, I welcome Tim McLoughlin to the podcast. Tim is a general partner at Cofounders Capital. They're a venture capital firm that invests only in early stage B2B startups. They have raised over $40 million, 43 to be exact, with their first two funds and are on to their third. Tim's experience reviewing, interviewing, and ultimately investing in B2B startups provided great insights for our conversation today. We not only discuss what they are looking for in early stage founders, but Tim also shares his perspective on why different startups fail and which ones ultimately succeed. This is a must listen for early stage founders and folks thinking about starting a B2B business. Enjoy, and now on to the interview. Hey, good morning, Tim. Welcome to the show.
Hey, good morning. Thanks for having me, Brett.
It's my pleasure to have you. I'm really looking forward to this conversation. You are my first official venture capital guest of any sort, so I'm anxious to get into that. But before we do, maybe you could give us just a little bit about your background in the firm and who you guys are working with.
Yeah, sure. So just a little about me first. I live in Raleigh, North Carolina. So we're a North Carolina focused fund. My wife and my 3.5-year-old and my 1-month-old are, working from home mostly these days. So we've been kind of in the house together, but that's a little bit about me. I grew up in North Carolina, went to Harvard undergrad, played a little hockey there. And then I opened and ran a hockey training company, a services-based company, which made me want to get out of services-based companies pretty quickly for 7 years after graduation. And that was, 2008, 2015, kind of scaled out programs across the country. And I went back to business school at UNC, Keenan Flagler. I got my MBA there, and that's where I got heavily involved in the venture capital and entrepreneurial ecosystem here in North Carolina. Met my partner at the fund, David Gardner, who is a serially successful software entrepreneur. He had just raised a fund in 2015, which was a $12 million fund focused on B2B software companies, seed stage revenue, pre-revenue or just at revenue companies in North Carolina. And so I joined him a few months after he raised the first fund in 2015. So I did not take part in raising that fund, but we invested out of that for 3 years, still have 10 active companies, 10, 12 active companies in that fund. And we are currently investing out of our second fund, which we raised in 2018, which is a $31 million fund, still focused on seed stage B2B software companies in North Carolina primarily. Although we will invest out of the state, we're opportunistic, but that's kind of our fund thesis.
Yeah, that's fantastic, and I love the idea of this services company. I get it, the margins are there, but man, you got to work hard, and it's
It's
harder to.
you're on a treadmill, and if you ever get off the treadmill, it all stops. So scalability of software was very appealing to me.
Yeah, and the other thing that's always remarkable, and if we shared a little bit offline, is the amount of investment you've made just in North Carolina, right? So people think about where can I start a company? It's got to be Silicon Valley, and no, and right, the Triangle area there, and maybe just for the audience, the Triangle comprises of which universities again?
Yeah, so we're very active at University of North Carolina, UNC Chapel Hill, Duke, and NC State are the ones where we spend the majority of our time. But we've been spending a lot of time, some more time. Davidson and Elon are both close by. Asheville and Charlotte, we can get there pretty quickly. So we're very active in the university ecosystem here.
Got it. And I think the audience is already probably aware why I'm excited to have you on the show when you've mentioned the B2B and then investment into that space. And just kind of curious, I know you joined a little bit later and you may have previewed the answer. Why B2B? What drew you guys into this space? And obviously if you've gone for a second fund and third one on the way, what was the draw for you guys?
Well, our pitch to our not only our LPs that invest in our fund, but to our portfolio companies is that we're going to be value-added investors. Most investors you're going to talk to are going to make the pitch that they're value-added investors. We like to joke that we actually mean it. Not to upset any other VCs that are listening, because I'm sure they all add value, but my partner David Gardner started and sold 6 consecutive B2B software companies between $10 and $100 million, but all good exits for his investors. And so that's where his expertise was. I learned a lot from him coming into the B2B space. I didn't have that background. I had entrepreneurial experience, but not the B2B experience. So I learned on the fly with my advisors and my partners, and as we grew the fund and our portfolio companies, helped me through that too. So that's kind of where I've gained some expertise. But when you're investing in a company, looking at B2B software companies, the entrepreneur wants to know that you've been in their shoes before. You've understood, you've felt their pain, and you know some of the challenges that they're going through, and you can speak with real credibility from the other side, from the investor side of the table to your entrepreneurs. And so I think, that was one for our LPs that were investing in us. They wanted to know that our team has been there and done that, but so do the companies. And so that's kind of focus on what you know.
Yeah, no, it makes a lot of sense. And the perfect segue into my next question is, what are some of the decision factors, or what are you looking for in these early stage B2B companies to make that investment? Because as you mentioned, most of them are post revenue, right? They've got a little bit of revenue, or maybe just explain really what is your thought process and decision criteria?
So it's kind of 50-50. 50% of our companies are true pre-revenue when we invest. Maybe they have a little bit of a technology that they built. They got a MVP, or they got a prototype, or they got something. The other half, have a little bit of revenue, have a beta customer, something like that. The first criteria is always the team, right? So we like entrepreneurs that are articulate. We like entrepreneurs that can explain their value props, their customers very quickly. We like to say that if we're 2 minutes into a pitch or on slide 5 of a deck and we have no idea what the company does, we're probably not going to invest. So that's kind of a starting point. And then another thing that we really look for is demonstrable ROI. We like solutions that are better, faster, cheaper, where we can sell one customer, do a case study, do a white paper, and then we can take that out and sell it over and over again to reasonable business people. So if we can get that case study and there's demonstrable ROI, that's something that's right up our alley. We're kind of industry agnostic, so healthcare IT, HR tech, fintech, kind of across the board, but demonstrable ROI is present in all of our investments.
No, that makes a lot of sense. I'm just curious, because from some of my work, I won't necessarily avoid, financial services or healthcare, but with some of the regulatory issues, it just adds a different level of complexity. So you guys are, I don't want to say, okay, if you see the opportunity, the demonstrable ROI, then you're good with that, or have you seen some challenges with?
Yeah, so here's kind of our secret sauce kind of what we do. When you're investing in companies this early, there's not a lot of diligence that you can do on the financials. There's not a lot of, well, what you can do is you can go and test the value props with potential customers, and you can start to get a feel for what the regulatory hurdles are going to be or what the objections are going to be. So we actually go with founders to try to sell their products. We talk to potential customers. We talk to customers that have passed. We try to understand before we invest, the key variables in the financial models that are driving those businesses. So what is the sales cycle going to look like? What is the price point going to look like? What is the real ROI for the customer? And to your question, one of the things with sales cycle might be that regulatory hurdle, right? What are the check marks that you need to see from this company? Security, what level of security do you need? What level, HIPAA compliant solutions, all that stuff to be able to sell. And that gives us a sense of what those hurdles are going to be, so we know how much money to put into the company.
Okay. Now that makes a lot of sense. And I guess that's a good, because one of the things, I work with obviously a lot of the B2B and the startups at different stages, not all tech, and kind of talk about a fundamental growth checklist, if you will, right? Here's the things that you should be, and it almost sounds like you're partnering with these companies to help them build those checklists out. Are there certain, 4 or 5 key things that you want to see every one of these companies? Obviously the ROI, but is there anything else particular that you guys are heavily focused on in those early stages?
Yeah, so I'd say it's traits around the founding team or the entrepreneurs. So coachability, right? Are they willing to take advice and feedback and incorporate it? One thing that we say is, we give some advice and feedback on, maybe try this a little differently in your next pitch, or maybe change this wording in your deck and just see how it goes. Are they open to that feedback? Because that's going to not that the VCs are always right, but they should take advice and think about it and maybe incorporate it. And you can tell a lot of that early on. Where we invest, it's really important that the entrepreneurs aren't stuck. They don't get entrenched on an idea or a belief that they had going in, right? So, what's their ability to pivot might not be the right word because that might be a little too strong, but to adjust their value props, for example. A lot of times they'll go in with a pitch and talking to customers, and the customer can say, "Well, we really don't care about that. Here is what we care about." Well, how willing is that entrepreneur to adapt, right? The way they think about that customer, the value props, the market. So that's really important to us.
I love that. Adapt and evolve, right? Right, because I throw pivot out quite a bit too, but you're
Yeah,
right.
adapt or evolve more so than pivot. And then the last thing I would say is we like to see a flurry of activity. So one thing, for example, is we'll an entrepreneur will come in and pitch to us. We'll really like an idea, and we'll say, "Hey, let's set up 5 sales calls. Let's go on. Let's do 5 demos. Let's shoot with some live ammo. Let's see what the results are and the feedback is." And if it takes months to set up those 5 calls or demos, that's a huge red flag because as an entrepreneur, you have to have so much activity. My partner David says a bird that flaps its wings once a day will never get off the ground, right? Being an entrepreneur is this flurry of flapping your wings and making mistakes, but doing it as many times as possible so you can really hone in as quickly as possible on what will scale.
Yeah, and that makes a lot of sense because if they can't even get traction with friendly fire or right friends of the program or your network, it's going to be really hard to get it to an unknown network. So that makes a lot of sense. And just one more question along those lines: Are you typical first time founders? Are you looking for this is their second or third company, or is it really more about the person and the team and the idea? Where do you guys fit on that?
Yeah, no, that's a really good question because we certainly know several funds that are very successful, but they focus on, serially successful entrepreneurs, right? Repeat founders that want to come in. That's not us. Not that we're going to walk away from a repeat founder, but we can't add as much value to that person that's been there and done it as we can to a first time entrepreneur. We're very upfront about that too, which is, hey, we would love to partner with you, but might not be the right investor because our strategy isn't to pay a premium on repeat founders. Our strategy is to help first time founders with what they don't know, right? To kind of give them the edge that a serially successful entrepreneur has and just work very, very closely with them so that, they don't make that catastrophic mistake, right? Or they pick up the phone and they call us when they had that one really important decision or that one term in a deal that could be a killer, a poison pill for the company. We want to be there to help walk them through that. And so we're a rare fund, I think, that says that we partner more with first time founders probably, but that's just part of our strategy, right?
Yeah, no, it makes a lot of sense. And two, my guess is I haven't worked with a ton of different serial entrepreneurs and founders, but they may not be as receptive to feedback right after being through the washing machine a couple times, right?
And to be fair, when we have the conversation early with them, we say, "Hey, listen, you've been there, done that. You can charge a premium for the experience you have." And by charge, I mean, valuation of your company right out of the gate. And so if you want a passive investor that's willing to pay more, maybe that's the right decision for your company. You own more of the company, you get money, you don't have somebody breathing down your neck or as much governance maybe as we would have. And so if that's what you're looking for, there's nothing wrong. There's nothing wrong with that. But for the first time founders, I think often they underestimate the value that someone that's an investor like co-founders or someone else that's been there, done that, right, has a portfolio that they work very closely with, can provide.
Yeah, makes sense. And based on that, so now you got a number of folks funnel. Now you've got people that you've invested in. Let's kind of talk about coming out the firms and the companies and the products that succeed, and the ones that don't. Maybe I don't know if you want to start negative first or go positive, but what are some of the characteristics? Let's go successful, and we can talk about maybe some of the things that didn't work for companies. So what are some of the top three or four things that
Yeah, let's keep it positive. So I'll keep it positive, and then the companies maybe that aren't doing as well, you can imagine they're on the other side of the spectrum of everything I'm saying. So the companies that are successful, a few traits. One, they hone in the variance of their assumptions that drive their model. Okay. Stay with me here. The variance of their assumptions that drive their model start to go to zero. They never get to zero. But when you make an investment in an early stage company, half your assumptions are probably wrong, but you don't know which half. The key is tracking those from a month to month basis and honing in those assumptions so you get more and more accurate. What assumptions are we talking about? We might be talking about the number of demos an average salesperson might be able to set up a month. Take it a step further down the funnel. How many of those demos are going to go to contract negotiations? How many of those are going to go to close? Well, if you are honing those on a month to month basis, it doesn't really matter how far off you are at the beginning. It matters that you're getting better and better at predicting it. And it's going to tell you a couple of things. It's going to tell you, one, whether or not you have a business or you need to make that pivot. Two, it's going to tell you much more accurately how much capital you need and where that capital is going to get you. And if you're able to take that process to a next round investor and say, hey, we were way off at the beginning. Here's why we misplanned. But look at the last 3 or 4 months, how consistent we've been with these metrics as we've honed them. Well, then it's more of a crystal ball than this financial forecast. We've proven this out over time. We've been tracking it. Here's where it's at. So the companies that have been successful really pay attention to those assumptions and tweak them on a monthly basis. Another thing that we encourage our founders to do is have a regular cadence with their investors and advisors. The ones that are saying, every 2 weeks or every month, I'm giving an update of the good, bad, and the ugly, along with an ask, are the ones that do the best because they're not just reaching out when they need money or when things are going really, really bad. So it's all about having a regular cadence and asking for help because at the end of the day, if you ask for help every month and someone hasn't responded and given you any of that help, it's really hard for them at the end to blame you, right? Or it's harder. I guess I still will, but it's harder. So those are two things that I'd say, you know, I have been traits, like very actionable traits that founders can do that separate our good and not as good companies.
And if you looked at some of those metrics, I'm a big believer in metrics, so I'm so happy to hear that, and that you mentioned kind of the sales process, which is critical at the early stage and looking at it. So is there a few key ones like conversion? Is it average deal size? I mean, those are probably some of the more obvious, but is there other maybe even operating metrics you're starting to look at as well as the financial as they're starting to mature a little bit?
Yeah. So the number one metric that if you go and tweak your financial model that you see as the killer is sales cycle. If you look at your price point or your average customer size, you can you're not going to be way off on what that is. Maybe you want to charge $10 per unit per month, but you find that the real market is $8 per unit per month. Well, that's not going to blow up your financial model. Maybe your customer size is you're shooting for 1,000 employee kind of companies, but you're really honing in on 750 or 800. Again, not going to be a deal killer. Go into your financial model and move your sales cycle from 6 months to 14 months. You run out of cash. I mean, it's the way it is. So that's one of the key things that I would say that people, need to put a focus on. And to that point, also breaking down your kind of customer segments. So if you have KPIs, sometimes it's helpful to have those KPIs with just an average, but sometimes it's helpful to have those KPIs per deal size. So I'll give you an example is just maybe with your small accounts, you have a 2 month sales cycle, and with your enterprise accounts, you have a 16-month sales cycle. Well, now you can really, there's no right answer which one you should be going at. But if you have those numbers, right, and you're tracking it based on those different customer segments, you can say, you know what, I shouldn't be going after the enterprise. I can gobble up the smaller accounts all day and look at how much more value I would get out of that if that's where we focused our efforts. So that's another thing. I mean, it depends on what stage you're at, but as you progress in your business, you're going to have this aggregate model with all these aggregate KPIs, and then you're going to have the ability to kind of segment it out as you go along. So it's just important when to make that decision.
Yeah, no, that makes sense. And do you even maybe take it a step further Do you advocate that they pick a specific vertical? Because one of the things I see a lot is, we can be all things to all people. We can sell everywhere. And then when you're the founder led selling still at that point, you can have those conversations. But, where do you see a, like I said, a focus or a niche, take one niche at a time, get good at, then expand? Or have you seen success with the other way where our product applies across all these different verticals? We're going to go broad initially. Does that make sense?
So yeah, I'm gonna do the safe right answer, which is it depends. but but here's the strategy that we try to deploy, which is going after three customer segments, maybe, or three different industries. That's okay, as long as there's a plan at the end of a certain amount of time to make a decision what you want to do at the end of that time. So let's say we're selling to enterprise, mid-level and SMB kind of for small businesses. We're testing with each one of those. Well, 6 months from now, let's come back and see where the real value is and where we need to focus our time. That doesn't mean we're unfocused at the beginning, right? It means that we're testing some different strategies. And at the end, if we have those three different strategies, 6 months from now, we plan to shoot two in the head or one in the head, and then really attack what's been working. That is a strategy, right? That doesn't mean you're distracted. That means you're really focused on what you want to test and then what you want the outcome to be. So that's what we kind of try to deploy.
Yeah, no, that makes a lot of sense. And maybe follow on question with, well, not follow on because I'm moving away from customer segments a little bit, but love your perspective on process and documentation, right? I know some companies that go completely over the top, too early, documenting everything and workflows. But then on the flip side, that as you're starting to get traction, you're getting more sales, none of this has been documented. And then when you want to start looking to scale, you got to start over. So I would love your perspective on the good, the bad, and the ugly, on and where you are with those types of
So when we invest, typically the CEO is the salesperson, right? The only salesperson in the company, the CEO is selling. And to be honest, if the CEO can't sell, we've never seen a situation that has worked where the CEO can't sell, CEO founder can't sell their product, but then someone else, some salesperson is going to come in and do a much better job. If you can't get that first 1 to 5 customers on your own, you're the most knowledgeable, passionate, you have the most at stake, if you can't sell, it's going to be hard to get someone else to do it, right? So step back. So the CEO founder is normally the first salesperson of the organization, and we always tell them to prepare for that handoff to that next person. That how they're going to, there's going to be that transfer of knowledge when that person comes in. So that means documenting objections that come up. That means documenting follow-ups with other sales folks, because the founders always get in this, you know, they have all that knowledge, and then such a heavy lift to transfer that over to somebody. So we always encourage them to start with a process that's going to scale, and it can be a lot, I think, up front, and maybe seem unnecessary. But when it's time to hand that off or make your first sales hire, make your first whatever hire. Same with technology, right? Your CTO not documenting anything, and then you need some redundancies in there. It's just such a relief when all that's been put in place up front.
yeah, not chasing exciting. One of the things I like to definitely with the newer founders is, look, these sales calls you're going on, this is going to be the core of your company, or at least your product, right? So the feedback you're getting, you're going to start to understand why they're buying it from you, which is ultimately when you start to build some content or marketing around it, it's going to come from that. And the other thing I like to encourage them to think about is your onboarding process. It's a pain in the ass, but if you want to keep those customers you worked hard to get, that's usually a good place to make sure. And again, I know every company is different, but 9 out of 10, that's usually the last place these companies are focusing on, is their post-sale customer.
Yep, one of the things that we've always talked about is you're onboarding your first customer, you're training them on your product. Why not work with them to create a video, right? That's scalable, right? That now you can put that on your website. Maybe it reduces some of the friction of the onboarding process, but it creates a roadmap and a blueprint for your first customer success hire. That's just an example that we've seen, is like So you've onboarded 8 customers now. You've done the exact same thing 8 times. You don't have it recorded and you don't have it written down. Why not? How much happier would you have been if you spent twice the time onboarding that first customer by creating some, scalable material than doing this 8 times over? So
Yeah, 100% agree with you. And when I moved out of management consulting back into the startup world, they train us on level 3 documentations, and you can just see eyes rolling like, all right, so I've learned, let's just go level 1, the key tasks and activities, which makes a lot of sense because as you grow, you can start to formalize that. I want to be respectful of your time, and we're starting to run out, but I do want to kind of ask, you talked about success. So after these companies are working with you through that phase, what's next for those companies? What's your ultimate? Obviously, you're going to follow on with some investment in certain companies. Is that maybe just a little bit of background on what you guys do with the successful companies?
yeah, sure. I mean, our main, one of our main goals, of course, our main objective is return of capital to our investor base, to our LPs. That's our fiduciary responsibility, and so that's where we focus. But also growing the entrepreneurial ecosystem in North Carolina is one of our missions that we have. So it's not only having successful founders and outcomes and return of capital, but building that network and ecosystem of successful entrepreneurs, or entrepreneurs that did everything right, but it just didn't work, that are now looking to start their next business, and knowing that those folks want to work with us again and are going to come back, and we'd be happy to fund their next venture. And so what's next? Building a network of professionals we worked with in the past that we want to work with again in the future, and that are embracing kind of the entrepreneurship mentality here in the state. I think that's kind of what's next, and hopefully that turns into a family of funds. Where Crunchbase is again ranked as the most active investor in North Carolina, and that's been running for a while now. And I'm a little nervous because COVID has slowed us down a little bit, but we want to. Not only do we want to keep that title of most active, that's nice, but one of the more successful ones with outcomes and building the ecosystem here.
Yeah, that's awesome. Awesome. And then I was going to ask you what really has changed. I mean, the world's changed and we've gone remote. I think it's accelerated a lot of things that we were heading towards anyway, but just curious from, even maybe your early stage or the companies you're just starting to engage with through the companies you're working with, have you seen massive changes or has it just been an adjustment period for you guys?
Yeah, the ones that took action quicker are the ones that are doing better. So everybody remembers kind of that Monday morning, or maybe in your world, whatever world, it was a Tuesday morning. But when you really looked at what the impact of COVID could be on your business or businesses that you're associated with, and what that was for us is, what would happen if we pushed all of our sales back 6 months, and if we zeroed out, the new investment line for our portfolio companies. And it was a real eye-opening experience. And so we tasked our entrepreneurs to go through that exercise and to take swift action right away. What do you need to do to right size your team? Do it all in one swift day, week, whatever it needs to be, so that you can keep morale with whoever's left on the team and ensure them that, they're going to be here for the long haul, and you right size the ship and all that stuff. The companies that did that have been definitely more successful. Now, the other thing, there's some things that are just out of all the company's control, right? Sometimes you have a product that's going to sell better in COVID, and you didn't know that. Nobody pitched us on that, right? There were companies we were looking at investing in, hadn't, and then all of a sudden COVID took off and they said, listen, we're not raising money we're selling like crazy right now. We're not raising money for another year or two because of all the customers we're onboarding. And then other ones, sales cycles got pushed back 12 months, and it's just not the fault of anybody. There is some luck involved to it. It has, I think, a little bit shifted our strategy on what types of companies we might be looking at, right? So,
Which
like,
makes sense. And the
we have
way
a
you do business a little bit too, right? Not much fewer, if any, or no in-person visits, and changes the dynamic as well.
and coming to a quicker decision. I think as a venture fund, we're have to be more selective right now with our investments. So fewer deals we're looking at a given time, so quicker feedback to entrepreneurs, and as to whether or not we're going to move forward.
Yeah, back to what you said, adapt and not pivot, adapt and evolve, or die in some cases. So awesome. All right. Well, my last two questions for you. One is, what's next for you and what's next for Co-Founder Capital?
What's next for me is hopefully getting back out into the real world with my new growing family personally. Hopefully that's it. And we'll get back to something what it looked like before COVID sometime soon, where we can all be healthy and do that. So personally, that's what I want. Professionally with co-founders, we've done a good job, I think, not only with our first and second fund at setting ourselves up to return good capital to our LPs, but positioning ourselves in the market with a good brand, with good, strong relationships where we're going to be able to raise a family of funds, hopefully fund 3, fund 4. I'm very, very lucky and I know what I want to do for the next 25, 30 years of my life. I know that not everyone is that lucky. I love what I do. And in order to do that, you got to, early on, you got to treat people the right way. You got to build those relationships so that you think about the long run, right? Co-Founders Capital Fund 7, in 2040 or whatever it's going to be, like, have you burnt too many bridges where that's not a possibility, and hopefully not.
And amazingly, if you guys are still only in North Carolina, even more impressive.
Yeah, well, the strategy is going to have to change fund to fund anyway, so
Yeah, I gotcha. All right, then last question, and I'll let you go, is what is one thing that you would highly recommend? It could be personal or business related.
Yeah, sure. It's really important. I think I touched on this a little bit, but the way we say it to our entrepreneurs is, you're always building a bench, right? And that kind of seems self-serving when you say it that way, but really what you're doing is you're always taking meetings, you're always helping people when you can, you're getting to know folks, even when there's not a direct right now objective, right? And so Brett, you and I've talked for several weeks now, and just kind of think about maybe down the line sometime we might be able to help each other out, right? We might be able to get in a deal together, or we might be able to, use your services. But there's no action on 'em right now, but you're building that network, you're treating people the right way. What we say is we're building that bench. So when the time is right, you have those people that you can count on, that you can call on. I think that's been really helpful for us. So that's the advice we give all of our entrepreneurs when we say, "Hey, I think you should meet this person," and they say, "No, I don't need that person right now." We say that's not the point. Meet with them, get to know them, build those relationships so that when the time is right, you can reach out to them quickly and they'll get back to you.
Yeah, that's such really good advice, and it's underappreciated, I think. I mean, I learned that later in my career, of the fact of giving and networking and doing it when you don't have to. And, my 3 daughters, I give that advice all the time. One, the world is really small, don't burn bridges. And 2, network and help, because karma will come back at some point in a positive way. So,
And one of the best ways to do it is set aside time on your calendar for those kind of meetings. Because sometimes you're going to fill them up with everything that, you need to be, you're thinking in the now and you're in the weeds and how do I just survive this month? Or that's the entrepreneurial mentality. But if I have 3 hours set aside on my calendar, which is just meet with some folks right this week, reach out to some folks I don't know that I would like to know with no real objective. I think that's a good way to manage that process and make sure you're thinking about it.
yeah, really good advice and a great way to end this interview. So much value, Tim. I really, really appreciate you taking the time. And if there's folks out there that want to learn more about you or the firm, what's the best way for them to connect and reach out to you?
I'll say this: if you can't find my email and my information to get a hold of me, then I don't know that it's worth us chatting because my information is always out there. So look me up on LinkedIn. Go to our website. You get my email and my number, and happy to chat.
Yeah, that's awesome. Again, Tim, thank you very much. We'll check in with you here in a little bit, maybe post COVID, when and if that time comes, and see how things are changing for you guys, and check back in.
Thank
Appreciate
you.
it.
Thanks
Have a
for
great
having
rest of
me.
your day. Thanks.
Yeah, thanks.